What's up, everybody? Today we're talking PayPal. The stock is down 64%, 65% over the last year. And the question is PayPal doomed? And will it ever be investable again? All right, so what we're looking at here is WiiJii.co. They have a lot of awesome dashboards and stuff for free that you can look at for stocks. So we're gonna run through a couple of the important metrics for PayPal right now. So we talked about the price performance, right? But how is the business performing? And here's how that looks in percentages. So started at about 22%. They had a high of about 30% revenue growth. And look, here's the problem. This is why the stock price is down so much. They still had revenue growth, but it was decelerating growth, right? 18% the next quarter, 13%, 13%, and then down to single digits, 7% and 9%. So this is the fear, right? Is this business, are they just stuck in single digit or worse revenue growth mode? And if so, then it's really not an interesting investment considering how expensive it was. Let's take a look at gross margins. And here's another thing. So it started up at 48% and now down 44. This looks worse than it really is, down to 42 and down to 40, but still, you don't want to see gross margins coming down at that type of rate that consistently, right? So a lot of people have questions about the business right here. Okay, and here's free cash flow. And this business just generates cash, which is kind of a beautiful thing. So 1.5 billion in June of 2020. By December or March of 2021, 1.5 billion. December 2021, 1.55, and then even dropped down, but still in June of 2022, 1.29 billion. And they've got a lot of cash on the balance sheet, right? They started at 13 billion in cash in June of 2020. They dipped to a low of 7.96 billion in March of 2022, and then in their last quarter, June 2022, 9.31 billion. So the business has seen some deceleration. They've seen lower gross margin, lower net income margin, and a lower cash balance. But the good news is it's such a cash generating business and has been such a profitable business, but that they are in no risk of any type of, insolvency or bankruptcy or anything like that. The question is just, is PayPal investable? And so their CEO, Dan Schulman, was actually at a investor conference, and here's what he talked about. So they were kind of asked about the larger picture and what's going on with transaction volume and checkout and just basically the health of the business, right? And so Dan Schulman, I'm just going to read this quote. Checkout is to PayPal as search is to Google. It's core to PayPal's DNA, and we have a tremendous number of advantages in checkout. You mentioned it up front. We have scale like few others in the world. 35 million active merchant accounts, almost 400 million active consumer accounts, which is pretty much 8 times the size of the next nearest digital wallet. Consumers trust and know the PayPal brand. If you do a consumer survey, there's one, it was just done externally, where 60% of consumers would prefer to use PayPal to do an online checkout. The next closest digital wallet was 8%. And we have some of the highest off rates in the industry, some of the lowest loss rates, and therefore some of the highest conversion rates in the industry for merchants. Last highlight I want to show you from this conference, he talked about the revenue is actually starting to pick up. They faced some pretty hard quarters because they had really strong growth coming out of COVID. Then revenue decelerated, but now it's starting to pick back up. So he was just commenting, we said our revenues would continue to accelerate throughout the year, 8% in Q1, 10% last quarter. And they said they're going to do 12%, and they're on track to do that. And they said EPS was going to grow at the same time. All of that is tracking in line. So this was just recently he said this. And this is even with the backdrop of all this economic and macroeconomic concern, right? Recession and all that stuff. So that all is on the table. But right now, PayPal is seeing their business continue to do well. Let's jump over to price to earnings ratio. And we're looking at since 2015. Okay, so back in 2015, it was trading right around 24, 25, 28 with 16%, 27%, 27%, 28% earnings growth. So pretty strong earnings growth. After COVID, things just got insane, right? All the way up to a PE ratio of 70. And so really, even when this thing just traded back down to kind of its normal, like it just got way overpriced, right? And so even if it traded back down to where it has historically been, which is, it's done great, the stock has done great, that was still a 47% loss, right? And so the reason this stock is down so much is not because this business is failing. It's because it got way too expensive on a price to earnings and price to sales multiple basis, and it needed to come down. Now, since then, now we have all these economic fears on the backside of COVID, and with all the money that's come in and interest rates going up, all this stuff, right? Everybody's scared and panicking right now. When people panic, that is awesome opportunities to invest generally for long term, right? And so I think that's what we have right now. And so now you can see it's down to a price to earnings ratio of 22. And really, it hasn't traded at 22 almost ever, at least since 2016, right? So the question is, what's going to happen moving forward? Well, again, we can go to forecasting calculators. Let's look at what analysts are expecting. They're expecting minus 14% earnings growth for this year, 2022, 22%, 18%, and then I have a pretty significant drop down to 11%, right? And so right now it's trading at a PE of 22. Okay, let's say we think that it is going to be, they're going to have only 11% earnings growth, which might be a little bit low, might be high, who knows. And we think it's actually going to trade down from a PE of 22 down to a PE of 15 by 2027. Pretty significant reduction there. You still get a 4% annualized rate of return. Does that break the bank? No. Is it amazing? Nope. But it's a pretty good margin of safety when you have the PE ratio coming down from 23 down to 15. And you have a pretty conservative estimate, in my opinion, for earnings growth. If we think PE is going to trade at about 18, then you get a 7.8% annualized return for a 48% total return. What if it trades up at 20, or 21, you get an 11% annualized rate of return. So let's put some numbers behind this, right? So first of all, this is everything money. So they've got this thing, 8 pillars, where they look at it's a little screener here that they think shows sort of the quality of the business, right? So they look for the 5-year PE ratio to be under 22.5. It's 38, so they get an X right there. But 5-year return on invested capital, over 9%. They're at 13.1. Check mark. Revenue growth over 5 years. Yes, the revenue is growing. Income growth over 5 years. Yes, the net income is growing. Shares outstanding actually down. They've done some buybacks. That's actually a positive thing. Long-term liabilities to 5-year free cash flow, they want it under 5. This is a sign of the strength of the balance sheet and their solvency, right? If they're at risk of going bankrupt, they want it under 5. It's at 3. That's a check mark. Cash flow growth, it has grown over 5 years, 5.36 billion, and 5-year price to free cash flow under 22.5. It's at 25.56. So they get next. Overall, pretty good score, right? Especially considering that the stock has sold off so significantly. So what I want to do is I want to create a little model here. I want to go 5 years out because I like to invest for at least 3 years. I'd rather invest for 10 years, but it's hard to project 10 years out. It's hard to project anything out, but 5 years I think we could do okay with. Okay, so we're going to need revenue growth expectation, profit margin, free cash flow, PE, and price to free cash flow, right? So what we could do, we could jump over to ticker. Again, these take pretty much the same analyst estimates that we're talking about. They've got revenue growth here, but what I can see is the compound annual growth rate, right? That's kind of like the average revenue growth rate. 13% they have through 2026. So I'm going to put that in the middle of the range, and we'll start maybe low 13 or low 10, middle 13, high 16. We'll try that out. And then right here, they have net income margins. They're expecting about 19% net income margins in 2026. All right, I built this little model out. Here we go. Here are our scenarios. The low scenario, 10% revenue growth, 16% profit margin, 19% free cash flow margin, 16 PE, 16 price free cash flow, and a 10% desired return, because we could just invest in indexes and get 8 to 10% per year. So we want to get better than 10%. Middle is 13% revenue growth. High is 16% revenue growth. Let's hit analyze and see what comes out. If we're looking at a multiple of earnings value, so we're looking at the PE multiple, then in the low scenario, we would want to pay under 76. That's about 20% lower from here. The mid scenario is under 106, which we're at 94. And then the high scenario is 145. And so I'll actually say, hey, notify me if it goes below 90, which is kind of the low scenario on the discounted cash flow. And then I also want to know if it goes above 145. If it goes above 145, then it's kind of on the expensive side, at least according to my estimations. The last thing we'll do here is we'll jump over to Morningstar, right? Morningstar is pretty conservative. They updated this on July 1st, 2022. They say PayPal is undervalued at a 30% discount. So the fair value at 135, the last close was 94. They give them a narrow economic moat, standard capital allocation. All right, there you have it. According to my prices, 106 midpoint. PayPal is a buy right now, all the way up to 145. If you think the low scenario is more true, then you're looking at either under 90 or under 76. Let me know what you think in the comments if you agree or disagree, and let me know if you have any companies you want me to study.